Today I'm going to break down a simple, step-by-step investing path that anyone can follow to become a millionaire. No fluff, no hype, just a practical guide that actually works. We'll use a $5,000 monthly income as an example to keep things easy to follow. There are 5 key steps on the journey to your first million. Step 1. Pay yourself first. Take 20% of your income and put it aside every single month to build wealth. If you make $5,000 a month, that's $1,000. This is where many people fail because of the wrong mindset. They say, I can't invest 20%. I have bills to pay. But investing what's left after spending is the wrong approach. The right way is to build wealth first, then live on what's left. Step 2. Eliminate high-interest debt. Before investing, you need to clean up your financial foundation. If you've got credit card debt or personal loans with high interest, anything above 7%, pay those off first. Think about it. If your debt is charging 18% interest and your investments return 8%, you're losing money just by standing still. Debt is the ultimate financial destroyer. Whether it's an individual or a company, bankruptcy happens for only one reason. They can't repay their debt. Clear your high-interest debt first, then focus on building wealth. Step 3. Build an emergency fund. Life is unpredictable. Emergencies like job loss, medical bills, or urgent repairs can hit at any time. Build a 6-month emergency fund to act as your financial safety net, so you don't need to go into debt or sell your investments in a panic. If your monthly expenses are $3,000, you'll need $18,000 to cover 6 months of emergencies. Don't wait until you've saved the full 6-month emergency fund before you start investing. If you're saving $1,000 a month, that's 18 months of waiting, and most people will quit before they even begin. The key to building wealth is investing. So we'll start investing right from the beginning, while also working on your 6-month emergency fund foundation. This video is a practical guide to reaching $1 million. We'll address both the reality and the emotion, because we're not robots. Our feelings impact how we manage money. Another benefit of starting to invest early is that it's the best time to learn while your portfolio is still small. You'll experience how the stock market behaves, including its wild swings. It's much easier to handle losing 50% of a few $100s than losing half of a 6-figure portfolio later on. Starting early also sparks curiosity. Once you begin investing, you'll naturally start paying more attention to financial news, company earnings, and the overall economy. That awareness is the foundation you'll need if you ever want to become an advanced investor. By investing from the beginning, you're giving yourself an 18-month head start in learning how the market works. You'll go through 2 phases when building your emergency fund. Phase 1, savings plus stocks. From your 20% income allocation, put 10% into a savings account that offers the highest interest and 10% into stock investments. Continue this split until your savings account reaches 2 months of emergency funds. This way, you're building your safety net while also getting started with investing early. The whole point of this 2-month emergency fund is easy access. You need to be able to use it anytime, no strings attached. We'll get into stock investing details later in Step 4. Phase 2, bonds plus stocks. Once you've got 2 months of emergency funds in your savings, you don't need to add more. Start putting that money into bonds instead. Now, allocate your 20% income as follows. 10% into short-term bonds using a ladder strategy. 10% into stock investments. This way, you're building the remaining 4 months of your emergency fund through bonds, while still growing your investment portfolio. Since this is for your emergency fund, invest in bonds that are truly safe, like U.S. Treasury bills. In this phase, I'll also guide you on how to invest in bonds using the ladder method. Start by buying a U.S. Treasury bill that matures in 4 months. Once it matures, reinvest the money into another 4-month T-bill. Keep reinvesting until you've built a 4-month ladder. 1 bond maturing each month, each covering 1 month of emergency funds and ready to support you when needed. Step 4. Go full force into stocks. Now that your emergency fund is fully set and your debts are cleared, It's time to shift your full 20% income allocation into stock investments. This is where real wealth gets built, by starting with a low-cost S&P 500 ETF like VO. For a passive investor, you can keep investing in an S&P 500 ETF until you reach your $1 million goal. It's simple, diversified, and historically delivers an average annual return about 10.5%, making it a proven path to long-term wealth. Keep investing monthly, whether the market is up or down, and let the magic of compounding do its work. Timing the market is nearly impossible, but staying in the market lets you benefit from long-term growth and compounding. All you need is just 1 hour a month to manage your investments, right from your phone, all the way to becoming a millionaire. For active investors, you can start pivoting to stock picking once you're confident in your emotions, knowledge, and skills, and ready to outperform the S&P 500. Be cautious. This is where a lot of people mess up. They jump into individual stocks thinking they're investing, when in reality, they're speculating, and speculation won't build long-term wealth. You can check out my other videos to learn more about stock investing, like stock market do's and don'ts. For practical tips every investor should know. So how long does it take to reach $1 million? Assuming a monthly investment of $1,000 with average annual returns of 0.5% for cash savings, 4.5% for bonds, and 10.5% for stocks, it would take 23 years to reach $1 million. A simplified formula to reach $1 million is investment capital times returns times duration equals $1 million. If you want to reach $1 million sooner, you can do it by either increasing your monthly investment or boosting your annual return. If you increase your monthly investment to $1,500 and achieve an average annual return of 15% from stocks, you could reach $1 million in just 16 years. This man was able to compound his investments at an average of 50% annually when his capital was still small. You don't need to be rich to start. Start to become rich. All it takes to complete this journey is discipline. Stay consistent and keep investing every month. This is Invest with CY. Your journey to $1 million starts now. If you'd like more clarity on any part, feel free to leave a comment, and don't forget to like and subscribe for more practical investing guides.